guys, in this video we're going to speak about fundamental analysis, dividends, and a few other key terms important for you to know. So let's get started. So fundamental analysis is essentially a way of analyzing a stock. It's the analysis of a company's financial statements to analyze the company's assets, liabilities, and earnings, to analyze the company's competition in the market and the health of the company. So what are financial statements? Financial statements represent a formal record of the financial activities of an entity as in a company. There are written reports that quantify the financial strength, performance, and liquidity of a company. Listed companies have to publish their financial statements. So fundamental analysis is typically analyzing the financials of a company and then deciding whether or not that stock is a good buy, or analyzing the stock's future based on these financials. So every time a company goes public or gets listed on the stock market, they have to release their financial statement to the public. So there are essentially three types of financial statements: balance sheets, income statements, and cash and flow. So balance sheets shows a summary of various assets, liabilities, and equities of a company at a particular date. Shows financial position of a company. So in my first video we discussed about assets, liabilities, and equities. So this is where it was required that knowledge. Second is income statement, or this is also called P&L statement. P&L stands for profit and loss statement. So this shows the company's revenues and expenses during a particular period. It shows the transition of revenues into net income, the profit or loss made by the company. So in simple terms, what was the profit or what was the loss made by the company? So this is shown by the income statement or the P&L statement. The third type of financial statement is cash flow. So this shows how changes in the balance sheet account and income affect cash and cash equivalents, activities that generate most cash, and activities that lead to outflow of the cash. So when we say activities, maybe we mean by the businesses. So example, if it's an industry and they're into many businesses, so which business is generating the most cash and which business is taking up the most cash, this is known by the cash flow statement. So fundamental analysis consists of two types of data: quantitative data and qualitative data. So quantitative data is the financial statements of the company, and because it's quantified, the numbers, and qualitative data cannot be expressed in terms of numbers. Example: management, business model, competitive advantage, corporate governance, market position, and industrial evaluation and growth. So qualitative data is essentially how good the management is, the business model, where they stand in the market. So this cannot really be quantified into numbers. So this is the quality of the company essentially in simple terms. So indicators are a term which is important because indicators are calculated on the basis of price and volume of a security. Volume indicates the volume of a stock over a period of time. 50-day volume indicator shows the volume of shares over a 50 days. So what volume essentially is how much a stock is being traded in the market. So if the share has a volume of 50 lakhs, essentially 50 lakh people are buying and selling the stock, if you get what I mean. As you can see this chart over here, it's of a volume of a company, and it's showing the volume and the delivery. So volume is how many people traded that stock, and delivery is how many people kept that stock. So many times people just buy the stock and sell it immediately, but the delivery is people who buy the stock and keep it with them. So this is a chart that shows volume and delivery. Volume also helps us understand the demand of the stock. So if high volumes essentially mean high demand. So now value investing. There are two types of strategy investing, known as value investing and growth investing. Value investing is a strategy of selecting stocks that trade for lesser than their intrinsic value. Now, What is intrinsic value? Before we get to this, intrinsic value in simple terms is the price that the company is deserved to be bought at. So this is the price that the stock is at deserving. So intrinsic value is basically that, and value investing is strategy of selecting stocks that trade for less than their intrinsic value. So example, if a stock's intrinsic value is 50 rupees, value investing would be selecting a stock that's trading that same stock is trading for 40 rupees because it's below its intrinsic value. Value investors seek stocks that the market according to them has undervalued. Value investors profit by buying when the price is deflated, buying it less than its intrinsic value, hoping that it would reach its intrinsic value, obviously. So this is value investing. Growth investing is a style of investment strategy focused on capital appreciation, investment in companies that display above average growth. So growth investing is believing that believing and investing in stocks that are displaying above average growth. That is essentially growth investing. Now, a very important term for you to know is PE, price to earning ratio. You would have often, when you go on any website, Google Finance, Money Control, any website and type a stock's name, something is going to pop up and that's called PE. And the full form of this is price to earning ratio. So this is a ratio that explains the price that you are paying for a stock compared to what profits of the company so a ratio that explains the price that you are paying for a stock compared to what the profits of the company are. So now many times if you go to Google and you type a stock's name on Google Finance, if a dash comes, that means the company is not making profits. The higher the PE ratio, the better the company. So the ratio basically explains the price you're paying for the stock in contrast to the profits of the company. EMH is a theory, and this is just a theory, but I think this is an interesting theory, and you guys would like to know it. Efficient market theory. So a market price of a security and this is just a theory, by the way, guys. So market price of a security always reflects all the information that is used to analyze a security. This theory is again against fundamental analysis, as fundamental analysis is analysis based on overvaluation and undervaluation. So this theory is essentially against fundamental analysis, as it states that all the information displayed when you search for a stock's name is what is required to predict the movement. But this is just a theory, and fundamental analysis is usually used by investors as it's a way of knowing if the company is overvalued in the market or undervalued. Now coming to dividends. Dividends, as we spoke about in the last video, dividends are a portion of the company's earning that is returned to the shareholders. It's like a reward to the shareholders, distributing the profits to the shareholders. Now, why do companies pay dividends? Here are some reasons. First, sustainability. Many shareholders want a sustainable and fixed income, and so will choose value stocks as dividends are appealing to them. Many times when stocks are undervalued, even though they're making profits, they may not go up and they may not give the returns to their shareholders the shareholders are expecting. But dividends are a way to reward the shareholders. Dividend yield. Now, if you again go and type a stock's name, dividend yield is going to pop up. Now, what is dividend yield? Dividend yield is a ratio that shows the relationship between dividends and the share price, indicates how much a company is paying in dividends each year as compared to its share price. A good dividend yield is between 2 to 5%. So how do you get the formula for this is dividend per share by share price into 100. So a good dividend yield is essentially between 2 to 5%. So a next important term under dividends for you to know is dividend coverage ratio. This is the relationship between the company's earnings and its dividends paid to its shareholders. So the formula for this is earnings per share by dividends per share. This is basically it shows a relationship between the company's earnings, what are the profits, and out of those profits, how much is going to the shareholders in the form of dividends. And by the way, I use the term earnings per share. That's calculated by dividing the profits of a company by number of shares outstanding. Now, this is very interesting. Many times stocks decide to split, which is known as a stock split. So a stock split is a corporate action that increases the number of corporations' outstanding shares by dividing each share, which in turn diminishes the price. So if a stock's price is 900 and it decides to split into two, this is just an example, then the price is going to go to 450. So it's a corporate action that increases number of corporation outstanding shares by dividing each share, which in turn diminishes the price. Again, I'm just reiterating the fact. So market cap does not change, as when the shares are growing more in quantity, the price is reducing, and so it's the same. Example, when it was $100 for 100 shares, and now when I divide it, when I split the share, it's going to become $50, but in turn the 100 shares are now going to become 200 shares. So $100 for 100 shares is going to be $50 for 200 shares. So the stock split is going to remain, the market cap is going to remain the same. So the reasons for stock splits are basically simple. If a stock has a high price and they want more people to buy the stock, they want to increase the demand of the stock, they can split it. And liquidity, as outstanding number of shares increases, which leads to increase in liquidity, as now more and more people can afford it. So this is the final topic that we'll be covering in this video, and then next video we'll be moving on to mutual funds, which is a interesting topic because fundamentally my last video is going to be comparing mutual funds in the stock market. So the last topic for this video is bonus shares. So bonus shares are free shares given to a shareholder of a company based upon the number of shares the shareholder owns. This is again a way of rewarding the shareholder. So in this video I basically summarized how shareholders can make returns and get rewarded. The next video is going to be mutual funds. It's a very interesting video and I hope to see you there. Thank you.